Welcome to Investors Insights. Our topic today is interest rates rising. We thought that was very appropriate with the Fed meeting this week. We got a lot of information for you. And before, though, we dive into all the details, I just want to welcome Adam Van Zant to the Portfolio Strategies team here at File Plan Partners. Adam has been with us for many years now, and we're thrilled to have him come over from the operational side to the advisory side. Knows the ins and outs of this firm, as well as been having dialogue with us for some time. So it's great to have you here.
It's good to be here.
Yeah, well, we're excited. And also, just for our viewers, just know that when one of us is not appearing in this vlog, like Bobby Norman this morning, he's currently out on business. And we like to take care of our clients in a variety of ways, whether phone calls, one-on-one appointments, or also team meetings like this. That's the beauty of having a team here at File Plan Partners. So with that, I thoroughly enjoyed the meeting this morning in terms of interest rates. We got a big week. Trey, talk about that.
Yeah, the biggest part of the week is the Fed meeting and their announcement. It's not necessarily what they're going to do, which is they're very likely to raise rates 25 basis points, but it's what they say that's very important. Because the Fed right now, in kind of our opinion, is the most likely driver of maybe the next recession, because the economy's growing. Nothing really seems to stop it, but the Fed has a history of stopping the party no one asked them to. And so the fear here isn't that this rate hike will push us into recession. The economy's growing. It's got plenty of strength to withstand 25 basis points. But what they talk about looking into next year, are they going to raise rates to a point where it hinders the economy? Do they hurt borrowing? Do they increase the short end of the rate above the long end, the inverted yield curve we've talked about.
So are you saying for our viewers out there, they're like the ref at a football game, and every now and then Trey Booth goes, bad call?
Yeah, I think I get they got to stick with. I get they got to stick with tradition. At this point,
Right.
But and we were very excited about Chairman Powell, not just because he's a pal, but also
No relation, I might add. No relation. I don't want that. Yeah.
In hopes that because he's not a traditional economist at the Fed, that he would look at things in a different light and maybe do things different. So far, he's kind of sticking with the Phillips curve playbook.
Right.
And so now that they've raised rates to what many would seem as a normal level, what are they shooting for? Are they still shooting for even higher and higher next year?
Yeah, and on that, through our vlogs, we've been saying that we saw interest rates increasing this year. So, but now, Adam, you brought up a great point about housing starts. So Trey's over here talking about the Fed raising rates and about sometimes they raise too far. Talk about the indicator that you mentioned in the meeting.
Well, it's important to keep in mind that housing starts are at the height of this expansion right now.
Right, okay.
So the rise and fall of these, they're good indicators that we could go into a recession.
Yeah, in other words, people stop buying houses if interest rates have gone up and they go, that's too much, I want to pay on a mortgage.
That's right. So it's definitely something to keep an eye on.
Right, so we're looking at canaries in the coal mine. That's a very good point that Adam brings up. It's the cause and effect. Higher interest rates, higher mortgage rates, fewer people buying housing.
Right.
So like Adam said, we're at a high of the expansion. Clearly, interest rates aren't impacting people quite yet.
Absolutely, yeah. The housing starts have room to go,
Right.
And if we see them continue to climb, then our chances of a bear market or possibly seeing a slowdown in the economy that's minimized. Right. So it was great points that you made. And then Ashley, you talked about Treasury bonds. Talk about that, the yield.
Well, speaking of interest rates, title of the vlog here today, the U.S. Treasury 10-year on the long end, as Trey was talking about a little bit earlier, intraday almost got to a record last week. It was 3.11% back in May. That was a record. We're at 3.10 now, so we're approaching it. And you think, well, why does that minor move matter? Well, we look at that because it's a key indicator of investor confidence going forward, because you're putting your money out long term. That's yet one more indicator that with all the tariff stuff you're hearing, we're just moving right over it.
Sure.
Basically with
That's
the
a great point.
strength of the American economy, that's the core of what people are voting with their wallet on, and that's another indicator of it.
Yeah, you see those long end keep going up. It gives the Fed a lot more room to raise the short end. If we stayed below 3, we were maybe 1 or 2 meetings away from having an inverted yield curve, which, as we talked previously, not good. Leads
Too
to
much of a
recession.
box.
Absolutely. So on that note, as you can see, we've got a busy week. Very eventful, and we're going to keep you updated as we look at these rates and what the Fed decision is. And also know that there's a lot of indicators out there that we're watching and how it can impact your portfolio. We thank you for taking time out of your schedule, whether you're at home, a coffee shop, on your laptop, wherever, to watch us. And we also greatly appreciate those of you that are forwarding this to colleagues at work, to your CPA, your other professional contacts. We've been thrilled with the response that we've gotten. So we want you to have a great week. We thank you again and look forward to updating you as the week progresses.